Hi, you're watching Your Money Matters on NDTV Profit. This show gets you actionable insight on everything personal finance related. And we've been speaking about mutual funds in all of the episodes this week. And the reason is that you've probably seen significant drawdowns in your portfolios over the course of the last few weeks when you've seen frenetic selling in the equity markets here in India. Now, a lot of the strategies that worked incredibly well in 2024 and perhaps even leading up to 2024, I'm talking about the year before that, are not doing so well as of 2025. In fact, they started doing a little badly towards the end of 2024 itself. Here I'm talking about a few momentum strategies. I'm talking about small cap mutual funds, which have seen significant drawdowns over the course of the last month and a half. What should you bear in mind if you've gone a little too aggressive on some of these strategies that worked very well? We'll talk about that, and we'll talk about what your strategy should be over the long term so that you can actually make the most of these corrections. Joining me to talk about this at the start is Prableen Bajpai, the founder of FinFix. Prableen, always a pleasure speaking with you. Thank you so much for joining me. Let me start with the conversation on momentum, because really it was the buzzword. There were a lot of schemes that were launched using this strategy. It did work, but anything that goes up very sharply also tends to go down very sharply, right?
Yeah, absolutely, Alex. And I think in the last 4-5 months, almost all strategies across categories, we've seen that there has been a huge correction. So yes, absolutely, it's gone up. And there is, since September of 2024, most of the momentum indices are down 20% plus as compared to Nifty, which is around 12%. And that is the basic premise on which it is built, actually, Alex. I mean, these are aggressive strategies. They work on the principle of buy high and sell higher. And so you are chasing the price momentum. And in any kind of a sharp downturn or a correction like we've seen, this is bound to happen. And it's not that it's the first time it's happened. That has been the trend if you look at the past drawdowns in the data over the last 15 years as well for these indices.
For those people that are curious about how this works, and even for those people, Prableen, that jumped in just because they saw the past returns and said this is great, let's explain to them how it works, how these indices are constructed, how this factor works. Essentially, it's identifying stocks from a basket, a wider basket, and those that are doing particularly well, the assumption is momentum will carry them even higher, right?
Yes, absolutely. So it works on that premise that there is a investor sentiment, and price is truly reflected by the investor sentiment, Alex. And that is why it believes that whatever is going up, there are price inefficiencies which happen. There is always a time lag by which information actually reaches the investors, and they tend to buy stocks even after the price has gone up significantly. So it is a very different style of investing, and of course it carries high risk. But absolutely, I think it has worked in the past. There are phases when it does exceptionally well, it beats the broader market indices. But with this kind of a strategy, because momentum is the factor on which it is these indices are created, we have to be prepared for the sharp downturns as well. And the the momentum which is used here is based on the 6-month and the 12-year price movement of these stocks. For example, in the December, the half yearly, the kind of the rebalancing which is there in the index. For example, Tata Motors has been dropped out because it saw a huge dip. So, a new stock has been added. So if we look at the Nifty 230 momentum index, that means that the investment universe is the top 100 large cap, and then the next, that means the top 100 mid cap stocks. And from those, based on this factor of momentum, that index is created. And we have two others. One is the mid cap 150 index, from where again 50 stock portfolios created. And then we also have the Nifty 500, from where again a 50 stock portfolio is created. So these are interesting strategies, Alex. In the past, we've seen that they've given phenomenal returns. They've always fallen more than the the Nifty 50, or the parent index, for example, the Nifty 200, the Nifty 500, or the mid-cap 150 in these cases. And the recovery period has been, differing depending on the phase when it fell. Currently, we are in the period where this is the fifth largest fall for these indices, and it's an ongoing fall, and which has been there for the last, almost 100 days plus. And during this time period, we've seen less than, almost half of a fall by Nifty 50. Yeah. So,
before we get into some of the strategies that you can use and how different strategies yield different results, Prableen, very quickly, can you explain why there is this behavior of the momentum index where in a broad-based selling or broad-based downturn, this index or this strategy falls even further?
Yeah. So because, Alex, we are only focusing on the price, and price keeps going up, and more and more investors, for example, there was a time when everybody was chasing defense stocks. So, then your friend tells you, oh, you don't have a defense stock in your portfolio, go and buy it. You want to buy a defense fund. We also saw a lot of AMCs actually launch the defense fund. Likewise, whichever segment starts to do well, the information starts to spread, and there are individual investors, there are AMCs which starts to launch. So there is a further push given to the price of those stocks. But when there is a correction, suddenly everybody starts to look at fundamentals, everybody starts to look at the fair price. And then there is a realization that, okay, maybe, you've overpaid for the stock. So the fall is sharper because the extent to which it had risen was much more than probably where it should have been. And it works well, Alex, because 6 months later, if we're just looking at the index, there are corrections and the rebalancing happens. There's a 5% capping on these indices where, they would sell that stock if it's exceeding that 5%. But because you're somewhere paying a little more than what it should be, what it is worth, as compared to in a market cap based index, the falls are harder. Yeah. And momentum works both ways. So people think that whatever is continuously going to go up will continue to do so, and whatever is going down will continue to do so. So it actually works both ways, but the falls are sharper because the focus is the price.
Okay, so we have to talk about small caps, so therefore this will need to be a little quicker. The SIP returns versus lump sum returns, you've shared some very interesting data. You want to take us through that?
Yeah, I'll just quickly cover it for momentum once, Alex, because I think for those who have already entered the momentum strategy, for example, if we are looking at a 5-year SIP return for, let me pick Nifty 500 Momentum 50 Index, for example, in the 5-year SIP returns have been 24%. But during this time period, Alex, there has been a correction of 32%. There was a phase when the SIPs were actually down by 32%, which is from September of around 21 till June 22. And in the last 1 year, the 1-year SIP returns are actually negative 22%. So the point I'm trying to make here is that these are volatile strategies, so it'll work. You have to have that 5-year plus horizon if you're looking at a momentum strategy in your portfolio. And similar sort of a data is replicated even if you're looking at annualized returns for a lump sum, which was done in 5 years. So that should be a minimum investment period, and you have to be prepared for a 25-30% kind of a fall when we're talking about momentum strategies. And something similar even in the case of small caps.
That's
actually,
exactly.
Alex,
exactly what we were getting to. So you've actually captured the drawdowns since 2016, and this is very interesting data because the tendency is to focus on the very recent past and look at the pain in the portfolio, and obviously that is more apparent right now, but this is something that has happened probably in the past.
Absolutely. So because we are looking at the Nifty 250 small cap index, Alex, and it was only launched in 2016. So of course, we saw that 18 and 19 were very weak for the small caps and mid caps. And so overall, there was a 60% correction. If you're looking at it was almost a time correction since January of 2018 till March of 2020, which also includes COVID. And this, it was almost a 2-year period when small caps, the index didn't really deliver any returns, and it was negative 60%. And again, the second largest fall was about 26%, which happened from January of 22 till June of 22. So even during the recent time periods when investors have invested, there have been corrections. Currently, we are down by about 18+%. And this is an ongoing correction that we are seeing. So it has happened in the past, Alex. And I think the basic rule here, which can help investors survive in momentum strategies or small caps, is that you have a longish time horizon. And I think that's very well proven by how SIPs work. So if somebody invested in January of 18, his 1-year SIP returns would have been negative 27%. 18 till 2020. So 2 years later, the returns would have been negative, almost close to negative 2%. And after 3 years, it would have been positive 13%. And these are the times when investors want to give up and go back to an FD or go back to something which is safer, for example. But 7 years later, today, the same SIP would have given about, and we are still, this is after correction, Alex. We are sitting in January 25, where we've already seen a decent correction. The returns would have still been 22%. So if you're entering the small caps, you have to have a longish time horizon.
And do not
be prepared.
stop. Do not stop
Yes.
the SIPs, because the unit averaging when the market falls is actually tremendously beneficial over the long term. Let's talk about some data in the latest drop, which is December to now, effectively. You've had quite interesting data, right? Because the category average of fall for actively managed schemes, as you've pointed out, is 16.5%. It's quite sharp, right?
It's quite sharp. And 14 of the schemes have actually fallen lesser than the category average, 6 around, and 9 have fallen more. So the highest fall is around 20%, Alex, in this 1 month plus period, with many of them correcting at 18, 19% more as well than the category average. And the lowest fall has been around 12%. So honestly, not many of the actively managed funds have been able to contain fall. It's this period from December till January, December 11th, till 28th of January, it has been very, very harsh for the small caps. But if we're just widening our time period a little and we look at, let's say since September, because that was the high for the Nifty 250 small cap index, then also there has been a decent correction since then. But the schemes, would vary a bit, which have been able to contain the fall.
Okay, so there are schemes that have lost a lot of money, but I want to focus on the ones that have actually managed to protect money, right? Because you still had a fall of about 12.4%, but that's less than the index. So therefore, what has worked in this case?
So broadly, if we look at these different time periods, Alex, and if we look at the schemes which have been able to protect the downside, I think 2-3 factors have worked. Number one is that they've had some bit of cash with them. That has been one thing. Second is some large cap allocation and mid cap allocations worked for them. And of course, within small caps, what are you holding? That is the main thing, that, what kind of stocks have you held within your small cap portfolio? Because you have to minimum, the mandate is 65% in small caps has to be there in all times. So within that, what is your composition? And beyond, I think how much large caps, mid caps and cash, that has actually made the difference for most of these schemes.
Because, so it's really interesting because in an upcycle, when you have an underperformance of most actively managed schemes in the small cap category versus the benchmark, but some of these very schemes may not have given you that kind of an advance, but they're protecting your money ultimately when the market is falling and equilibrium point is received. I think this is true, Prableen, for everything in life, right? When the tide goes out, the tide comes in, right? Eventually, there is a balance that is sought and found. And I guess you have to utilize both wherever possible. Prableen, thanks so much for joining in and for giving us a perspective that you did. Very interesting data. And I think for me, the big takeaways are continue your long-term investments and keep a slightly longer horizon. Of course, everything that happens that is bad has actually occurred in the past and you've gone past that. Thanks so much for joining in.